Joining us now to talk about how the third quarter would have shaped up for FMCG players is Harit Kapoor of Investec Capital Services. Harit, good having you. Thanks much for taking the time out. Appreciate you being with us today. At the onset, just wondering, is your sense that the numbers might be a bit difficult to gauge for quarter three, considering a lot of companies have said that because of the protests around the nation in the months of December, sales might have gotten disrupted?
Yeah, hi, good morning. Thanks for having me. There are two factors which are really playing into the performance for November and December for companies. I think the first part, as you said, is the protests, which have seen some level of disruption. I wouldn't expect this to be significant in the context of the numbers, but there has been a slight impact on account of this, especially on the ground for the wholesale trade. The second part is, on the winters. So typically companies upstock in September, late September, early October, expecting the winter to set in. And this time the winter has been delayed. So it has set in sometime only around, mid-December. So that has also, been an impact for companies who have not seen the kind of sales that they expect, specifically in the months of October and November. So these two factors have been, pieces over and above what anyways is a fairly, slow growth environment for consumer companies right now.
Okay. So in light of all of this, can they spring a surprise, or would you believe that we would have a tempered quarter? And what would be more tempered? Would it be volume growth? Could it be margins? Could it be a combination of both?
Yeah, so I think if you look at quarter two versus quarter three, I don't expect the revenue growth at an aggregate, if you do an average for the top 8 or 10 companies, to be very different for quarter three over quarter two. I think there are 2 or 3 factors at play. One is that while the demand environment hasn't gotten any better from Q2 to Q3, it also hasn't really incrementally slowed much. So so that's one key factor. I think secondly, you have seen the initial signs of certain price increases also starting to come through, and a slight level of promotional intensity in certain categories come off. While, as I said, in the winter, skincare categories, there has been a continued increase in promotional intensity because of the fact that sales have been tepid. But at an aggregate level, you have seen, the pricing mix part improve just a little bit versus quarter two. From a aggregate revenue perspective, I see a very similar trend. If you take quarter two and quarter three, at an average, quarter two had about a 5.5% kind of a revenue growth. If you take an average of the top 8 or 10 companies, I think a similar trend will persist in quarter three. The good part is you're not seeing a slowdown from there, but there is also no real pickup. I think if you look at 6 months earlier, we were expecting that the second half of the year should see some green shoots. So far, we haven't seen that come through. From an operating margin perspective, however, there aren't too many challenges. If you look at the home and personal care companies, at a base level, some of the commodity costs, at least in quarter three, have not been a challenge. And you've also seen advertising spends not being significantly higher. So you have probably some savings coming in advertising spends as well. So from an aggregate operating margin perspective, I still believe operating margins will be higher than they were in Q3 last year. The food and beverage companies, the food companies specifically, are seeing higher pressure because of milk prices, wheat prices, sugar prices moving up. So from that context, there will be some gross margin pressure. As I said, at an aggregate operating margin level, since advertising spends, which is a large proportion of overhead costs for all these companies, are going to be not higher than revenue growth, in fact a bit slower, I do expect operating margins to be fairly okay. So at an aggregate level, I am building an operating margin improvement for Q3 versus Q3 last year. So while the revenue growth will still be in the 5.5% range, I expect operating profits to be upwards of 8 to 9%.
Okay, so in which case can I push you to tell me which of the pockets or which of the companies do you expect will clock in the best aggregate performance according to you, and where is it that you have a serious concern of the performance lagging what the consensus estimates might be?
Yeah, so I think if you look at the companies that did well in quarter two as well, whether it's HUL, which showed a 5% volume growth with high teens EBITDA growth, while I think there will be the numbers will be a little lower than that in Q3, but still, if you compare to peers, I still expect a 5.5% kind of revenue growth there with EBITDA growths upwards of 15%. So I think HUL will be one of the better performers at a peer. If you compare with the peers, I think Nestle also, given the fact that urban markets have done better than rural markets, the rural slowdown has been significant, and Nestle's salience to rural is lower than its peers, should see an aggregate strong performance on the revenue, actually building in like a 10% revenue growth with, in spite of the fact that they have a cost pressure, I do still believe that they will be able to continue with the double-digit EBITDA growth as well. I think these two companies should continue to see good positive growth. I also expect Dabur to see a fairly good quarter as well, with a 6% type of a revenue growth, with operating margins being higher and a double-digit EBITDA growth. I think these three companies should see fairly good performance. I still think these are not blockbuster performances, but just relative to peers, I think these would be probably a little better off.